Okay. Hello, Cactus Ninja. Hello, Chain. Hello, Elliot. Hello, Frank. Hello, Jim and Corinne. Hello, John. Hello, Laura. Hello, Nadia. Hello, PSG. Hello, Thomas. Hello, Tyler. Hello, Vicky. Hello, ZK. Hope everybody's doing well. And just wanted to kind of get you up to date with the strategy. And we won't do the entire strategy today, but we'll start doing these little beginning sessions for just kind of, and it's good for anybody just to kind of, get into the groove, make sure you understand what the entire strategy is about. So we appreciate you being part of our group. So, first of all, I want to direct you to our trading plan. And within this trading plan is everything that you need to know. And you know that this is under the written trading plan tab. So everybody should have this one. And I have posted the latest one, which is 42424, which is the latest and greatest plan. But let's just go through a little bit of it. And first of all, you need an objective. Now, don't follow my plan, make my plan your plan. Change things up as you would like. But the trading plan strives to quantitatively extract profits. That's what we are. We're quant traders from financial markets. And we utilize S&P 500 index, SPY, XSP, the micro E-mini S&P 500 index, or the E-mini S&P index futures. And what we strive to do, y'all, is to eke out a minimum of a 20% annual return. All trades are entered into an Excel spreadsheet, and the spreadsheet monitors the overall portfolio metrics. Now, keep in mind, if you could make 20% a year, you are among the elite traders in the world. Now, we're not Jim Simon's material. He did about 66%, I think, per year. We're not quite there yet. But if we can eke out 20%, you can double your money in 3.6 years, which is really, really good. So our strategy is composed of two primary components. We have the naked puts, and then we have a put debit spread. Simple as that. Portfolio metrics. Now, here's where a lot of people mess up. You start looking at your trades first instead of your metrics. The first thing that you do every day is look at your metrics. And we look at delta. Delta, ladies and gentlemen, is nothing more than the speedometer in your little trading plan here. It is the speedometer. Delta represents the directional risks of the portfolio. Are you long the market? Are you neutral the market? Or are you short the market? Normally, we are long the market, but we're long in a way that I still consider it to be relatively delta neutral. So if you ask Tasty Trade what their delta should be, if they want to be delta neutral, is they say between 0.2 and 0.4% of your account in deltas. So on a $100,000 account, Tasty Trade says if you have between positive 200 and 400 deltas, that your portfolio is delta neutral. I made it a little bit more restrictive. And I said, if you take 0.15 times your portfolio, that you're going to be delta neutral. So on a $100,000 account, I don't like my deltas to get more than 150. So you just take 100,000 or 50,000 or whatever your thing is and divide it or multiply it by 0.15. And that is your deltas that you want in your account. If it's over that, then the spreadsheet recommends that you have short deltas added to your portfolio. Okay. And you'll see that here. See, yesterday when I traded this account, it was 463 deltas. So what I did is today I closed some positions and got my deltas down from 463 down to 366. See, yesterday I was in red. Yesterday I was at 54% of my buying power. Today I moved that down from 366 and I moved that down and I moved this down from 54% to 45%. And see what happens is your spreadsheet will tell you, oh boy, your two positive deltas here, you need to get some negative deltas in there. So what it was showing me is that I was too long. Now you've got to ask your question. If even though this is violated, yesterday I didn't make a change. So you've got to say, am I comfortable with the risk? Am I comfortable with, with that too much delta? And if you are, then you don't have to do anything. But I just want to make sure everybody understands. So delta is speedometer. Theta is our fuel gauge. How much fuel do we have in our tank? Theta is the fuel upon which our portfolio runs. A primary goal is always to maintain a minimum theta of 0.001 times the portfolio's net liquidation value. Let me make that simple for you. If you have a $100,000 account, you would want a minimum of $100 in theta in your account. Okay, so let's look at my account. Under this VIX scenario, it says that my max theta is the same thing as my minimum theta, which is 0.10%. I am right there at it. Y'all, I have a $270,000 portfolio. My theta is at 233. Ideally, theta would be at 270. So I would be at 0.1%. Okay. So $100,000 account, you want $100 worth of theta. All right. So let's go back to the trading plan. Now, the cool thing about the theta one is that it's not constant. The more volatility that we have in the markets, the more theta that you can have. Remember, volatility equals opportunity. So if the VIX is above 40, then I can have a maximum theta of 0.5. If VIX is between 30 and 40, I can do 0.4, between 20 and 30. So right now, VIX is at 14. And that's why my plan says, hey, your minimum and your maximum theta is the same. Okay. So it's dependent upon the amount of volatility in the market. Okay. So right now, you want to be at about 0.10% theta. Now, let me go here and show you this. The third thing is our tachometer, our buying power. How much is the engine revved up? And everybody probably got a tachometer on your car. It shows the revolutions per minute. There, you don't, 5,000 per minute or whatever. You don't want to have too much buying power in use. So buying power ensures the portfolio's overall position sizing is not too large and the portfolio is not taking excessive risk. It is permissible to run the portfolio at approximately, now look, my trading plan has rules and then my trading plan has permissions. One of the permissions it gives me is it's permissible to run the portfolio at approximately 50% buying power if the underlying price is above its 200 daily simple moving average or above the 10-month simple moving average, and the 10 weekly exponential moving average is above the 20-week exponential moving average. Oh my goodness. Otherwise, the buying power will be allocated per the chart below. So we will look at this in just a second, but otherwise, my buying power is based on the VIX as well. So let me show you this. Right now, I should only be using 25% of my buying power.
This shows up.
So under normal circumstances, I'd be using 25%. If VIX is between 15 and 20, I use 30%. Between 20 and 30, I use 35%. Between 30 and 40, 40%, or above 40, 50%. But I have the permission again to use 50% of my buying power as long as we are above certain things. So I want to show you what that looks like. So let's go over here. And I should have the 200 daily moving average. Just show you what this looks like. So here's ES, and you can see this is the daily chart. Here is its 200 moving average. As you can see, ES is well above its 200 moving average. That means I have the prerogative, but not the obligation to use up to 50% of my buying power. Everybody got that? The second thing that I look at is the 10 EMA versus the 20 EMA on a weekly chart. And you want to make sure that the 10 is above the 20. So this little line here is the 10 exponential moving average. And as you can see, it is above its 20 exponential moving average. As long as that is the case, I have permission to use 20% moving or 50% of my buying power. Okay, 50% of my buying power, as long as that is in play, and indeed it is in play. Okay, now one I also kind of look at is, instead of the 200 moving average, you can look at the monthly moving average. And you just want to make sure that your price is above its 10 monthly simple moving average. This is a monthly chart, and indeed the monthly price is above the 10-month moving average. So that way I can use up to 50% of my buying power. Okay, let's go into the actual strategy now. So the strategy is this. Any questions on the first three things? Tachometer, we got speedometer, we got fuel gauge. Make sure everybody's good to go. Anyone got any questions? Okay. Components of the strategy. Now, you can either do a 1-1-1 trade or a 1-1-2. Now, either of these is fine. Some of you like doing 1-1-2, some of you like doing 1-1-1. Now, I have been, as you've noticed in our daily time together, I've been doing more of the 1-1-1 trade. Why? Well, it's because I have less notional exposure. In other words, instead of having the potential of one put or two puts go to zero, I have the potential of only one put going to zero. So there's less notional exposure, but either is fine. And a 1-1-1 trade is comprised of an out of the money put debit spread and one out of the money naked put. The 1-1-2 trade is comprised of an out of the money put debit spread, same as the 1-1-1, but it's got two out of the money naked puts. Ideally, a 1-to-1 ratio of naked positions to put debit spreads is preferred. So either one or two puts are sold. Days to expiration, we go closest to 120 days. Now, yeah, I'll help you with that at some point, ZK, to understand how to set up the charts. We'll do a Green Monster class as well to show you how to draw that on your own, or you can just let me share my chart with you every month as well, which I'll be happy to do. So if I'm doing a 1-1-1, I'm selling one 10 delta put for the 1-1-1 and selling two 5 delta puts for the 1-1-2. What does that look like? So let's go out to, let's say you're doing it on ES or MES and you do trade. Depends on the size of your account. Some of you guys may have some smaller accounts. I'm not sure. So let's go to MES and let's go to trade. We go closest to 120 days. So we got 112 or 140. So I'd go to the 112. And I would go to, surprise, I've got something here on this account. Okay. I would go out to the 10% probability of being in the money, which would be right here. Everybody see that? I would go right here. It's not showing the 10, but I'm assuming that's 10. Here's 9% probability of being in the money. And I would sell the 4,800. Get 31.25 if I was doing a 1-1-1. Now, if I wanted a 1-1-2, I would go down to a 5%, and these numbers are all wonky here, but I would go down here to about a 5% probability in the money, and I would sell two of these. So 1575 times 2 is giving me about 3150. I know what you're saying. Well, Bobby, you're much safer here. Why wouldn't you do that? Well, because you've got two naked puts. Right here, I've only got one. Okay. So let's go back to the plan. Now, management. Naked puts are not usually closed at 95% profit or when they reach 30 to 21 days to expiration, but subject to overall portfolio metrics. You don't have to close them. As long as all of your metrics are climbing up, there's no need to close them. In other words, if this is green or blue, and this is below 50%, you don't have to close anything. Your metrics are saying everything's fine. All right. But normally I'll close those when they reach 95% profit or when they're 30 to 21 days to expiration. Now, I know a lot of people take these things, every one of them, to expiration, and that's fine too. It's really fine. These are really, really safe out there most of the time, and just monitor your portfolio metrics. It is acceptable, ladies and gentlemen, to allow the naked puts to expire out of the money. Let's look at why I might close them. If that naked put that I sold for $30 becomes $90, it is permissible to close the naked puts at a loss equal to 2 times the initial credit received. So if I received $30 on those and all of a sudden it's $90, that means I would lose $60, then I can close that trade. Now, Tom King does it differently, and that's fine. Tom does if it's 1x loss of the max profit on the entire trade, including the trap, then the max loss is equal to the max profit, then he takes his off. That's fine too. Now, here's the cool thing, y'all. This is really cool here, is we have problem child status. If the short strike becomes a 30 delta or higher, permission is granted to either close the trade and just take your loss. Say, you know what, the market got me. What
The birthday party, you know how we have our own funds, but they can't take ours.
Okay.
So like, we can share ours, but when we want it back, they have to give it back.
Oh, they will, yeah. Or put the trade in problem child status where the debits and credits of the trades are monitored to ensure that the trade is ultimately responsible. So let me show you about the problem child status. The puts are closed for a loss. Let's see, do you put the stop loss orders right when you get to fill on the naked puts? No. You cannot do stop loss orders on futures products. So I just monitor mine, by looking at them. And really, most of the time, you never get to a 200 loss most of the time. So I really don't have to, you can't put stop losses on futures. So you really just have to look at it. All right. So you close the put for a loss, you roll it down further away from the underlying price in the same expiration and reposition by selling twice the number of naked puts so that the credit received is equal to or greater than the debit required to close the initial puts. And thus it becomes a 112 or 114. Or alternatively, the position can be rolled out farther in time. And this is what we do most of the time. Roll it out farther in time and possibly farther away from the current price of the underlying and reposition so that the credit received is equal to or greater than the debit required to close the initial puts. Let me show you what that looks like. On your spreadsheet, you have a problem child status. So I want you to see how this worked out here. Last March of 2023, it was my 111. It was the 17th one that I done for the year. The initial trade brought in a credit on that naked put of $408. Look at this, y'all. The market went against me and I closed it for a debit of $1,600. That resulted in a $1,200 loss. Ouch. All that I did was roll out in time by selling a second naked put so that the credit received was equal or greater than the debit to close the first trade. You see that? Very cool, y'all. So I sold another put for 1609, which fully covered this. Then my put debit spread, I was able to close. This was in the micros, and I was able to close for a full winner. So I got $200 from the put debit spread. And then eventually, when the market settled down, this that I sold for 1609, I was able to close for a debit of 411. And look what happened. I had a debit of 2017. I had a credit of 2217, and that ended up being a $200 winner. How cool is that? So let's see what that sounds like. So let's say that today I sell the 4,800, okay? And let's say that the 4,800 becomes a 30 delta. All right, well, what is that? Let's go up, see, we see 30 delta here. That means it becomes $87 here to close. See that? Now you're saying whatever you sold for 30, you're going to have to close for 88.50. Ouch. Now remember 88.50. What you would do is close that put, right, for 88.50. You've lost $50 per contract on that. Now what you do is you go from 112 days and you go out to around 140 days. And then you're going to sell something like this 51.50 for $93. That's all rolling out is. That's all it is. Now, the problem is that with MES, you don't have that many expirations to roll, right? Look, you got 140 days and then you got 168 days, and that's it. With ES, if you're trading in a bigger account and you can do ES, it's so much easier to roll and find a credit. Look, if you were at 112 days, you could go out 122, 140, 153. Look at this. You could go all the way out to 1,294 days. So you're able to roll that out and extend duration. So that's all problem child is. And at some point, if the market were to keep rolling against you, going against you, you just keep rolling out farther, right? You're just kicking the can down the street, hoping that volatility subsides and goes back to normal, and that those puts that you sold for that really big credit, that 88 credit or $93 credit, that you can close that so that your entire trade can be put on for a credit. Very kind of cool, isn't it? All right, so let's go now to the next part is our put debit spread. Put debit spread is bought, days to expiration, same expiration as the naked puts. They're 50 points wide. I normally get them at $10 debit, so that means it costs me $50 because there's a multiplier of 5 on the MES, or it would cost you $500 for ES. Look for the long put to be at approximately 25 delta, and 99% of the time, y'all, the put debit spread is going to expire worthless. Permission is granted to close the debit spread before expiration if the spread is approaching full profit. So on a micro, that would be if it's at $200 full profit, heck, close it. It can't help you anymore. Or the current price of the underlying is under the profit tent. So you've got a profit tent that looks like this. And let's say that price is right here and you've got a nice little profit, but you're thinking, you looked at the big green monster, the price is going to go back up here. Well, heck, some profit's better than no profit. Take it, right? If you think it's at risk of exiting that tent. Or I always make sure to close any leg of the put debit spread that is in the money so that I don't have exercise and assignment fees. Check with your broker on how they handle that, but you wouldn't want any leg to be in the money. So here, this is where your short put is. See, it knocks down. This is your short put there. Your long put is here. And if price is here, then both the short and the long are in the money. If price is here, then only the long is in the money. And again, you don't want to wake up and have either one of those be put to you or taken away from you. That's why you close it. Y'all, that in a nutshell is the 1-1-2 trade. It's so simple. And then you do it over and over and over. And there's 5 steps to our strategy. I'll show you the 5 steps. And the steps are really, really simple. Number 1 is we sell premium. Now we do buy put debit spreads, but we're selling premium overall at a high probability of success. High probability of success. When I put these trades on and I normally look at it in Tasty Trade, it says that there is a 93% probability of success on these trades. I like those odds. And then here's the hard part, sitting on your hands and letting theta decay. Just sitting on your hands and letting that nice, sweet theta decay. Now, here's where we spend 80% of our time talking about and that is managing chaos. Right? What happens if the market tanks? We spend 80% of our time talking about this, and we've got the trading plan has about 8 different things that you can do. And then here's the sweet part, y'all. Rinse and repeat. After 15 weeks in our strategy, you should be closing one and opening one. Close an existing trade, open a new trade. And it's really kind of simple, just over and over and over. All right, who's got questions? It can be about this or anything. If we're just starting a new 11X campaign and have a lot of buying power to use, how would you enter? Like a lot at once? No. Tyler, what you want to do is build it up. You want to build it up. Now, in one of the spreadsheets, I haven't released it yet, so you might want to ask me to get the calculator, but I actually have a sizing calculator that says, hey, how much should I be putting on one? And then in this thing, it says I need to be putting on 1.5 trades per week to build it up over the 15 weeks. So if you'll ask me for this, I can send you a spreadsheet. As long as y'all are in the Muscadine Mafia, the Hello Ladies Gang, or the Ninja Nerds, I can send you a worksheet that has a sizing calculator on it that shows you how big. You just need to figure out how much a 111 or 112 costs in buying power for you to put on, what the buying power after 15 weeks is. So compare it to one and maybe we can do this next week and go through the sizing calculator for you and figure out how many of these tranches you should put on per week. But if you've got like a $7,000 or $8,000 account, you should be doing between 1 and 2 a week. No, between 1 every week or 1 every 2 weeks. That's where you should be on about a $7,000 to $8,000 account. Do you start the BSH first or 11X? You start the 11X first because you really don't need and we can talk about that in a different session as well. But I just want you guys to get familiar with the 11X trade. It's a wonderful trade. Why I started doing this trade 100% and forgot the strangles and the straddles and the broken wing butterflies is back during 2022 when nothing was working. This trade during a bear market was working phenomenally. Oh, it was good. And I think it's an all weather trade where you can do it in bull markets, bear markets, sideways markets. It's a great trade. Okay. Good session, y'all. I appreciate y'all coming. We'll do one of these next week too. We'll go into maybe the sizing calculator. Y'all remind me to do that for you, and we'll go and show you how to do that and to use it specifically. But I appreciate all of you being a part of our community. You don't know what it means to me that you would trust us. And it's a great community. No a-holes. You can ask anything. And if ever you have any questions, then when do you start the BSH then? Whenever you think you need probably after 3 or 4 11X trades, then that's when you can do one. Yeah, and then just start that organically. I see triple top on weekly on ES. Would you start a 112 campaign today or would you wait? Nadia, if you think that triple top means that you're going to have a down day, then I would wait until that down day comes. But I always say, hey, it's better to start now than later. It's a very forgiving trade, even when the market goes against you. Absolutely. Thanks, y'all. I appreciate it. Y'all have a great weekend. I'll see y'all Monday. Love you to pieces. Bye bye.